Picture this. It's the early 2000s. The American dream seems more achievable than ever. Owning go home, a symbol of stability and prosperity, is within reach for millions. But beneath this shiny surface, a storm was brewing, a financial hurricane that would shake the entire world to its core. This is the story of the 2008 financial crisis, a tale of ambition, greed, and a system pushed to its absolute limit. So, how did it all begin? It started with something that sounds pretty safe. Mortgages. For decades, getting a mortgage was a straightforward process. You needed a good credit score, a steady income, and a down payment. Banks were careful about who they lent to. But in the early 2000s, everything changed. Wall Street had a brilliant and ultimately disastrous idea. They started bundling thousands of individual mortgages together into complex financial products called mortgage-backed securities, or MBS. Think of it like a fruit salad. Instead of selling one apple or one orange, you mix them all up and sell shares of the entire bowl. These MBs were then sliced and diced into different pieces, called tranches, and sold to investors all over the globe: pension funds, insurance companies, even other countries. The safest slices got a AAA rating from credit rating agencies, the highest possible stamp of approval, making them seem as secure as government bonds. This created a massive, insatiable appetite for more mortgages to feed the machine. Suddenly, the old strict lending standards went out the window. Banks started offering what we now call subprime mortgages to people with poor credit and unstable incomes. You might have heard of ninja loans. No income, no job, or assets. It sounds crazy, right? But lenders weren't worried. Why? Because they weren't holding on to the risk. They would just package these risky loans into more MBS and sell them off to unsuspecting investors. As more and more people got easy mortgages, demand for houses skyrocketed. This created a massive housing bubble. Prices were going up, and it felt like the party would never end. Homeowners were refinancing their houses, pulling out cash to buy cars, go on vacations, and live the good life. Everyone was making money. The lenders, the Wall Street banks packaging the securities, and the investors who were getting great returns. It was a gold rush. But here's the problem with bubbles. They always burst. The first sign of trouble came when interest rates on those subprime mortgages, which often started low, began to reset at much higher rates. Suddenly, homeowners who were barely managing their payments were faced with bills they simply couldn't afford. Defaults started to trickle in. Then it became a flood. People were losing their homes. Now, remember those mortgage-backed securities, the fruit salads. They were starting to rot from the inside out. The subprime mortgages, the bad apples, were contaminating the whole bowl. Those AAA ratings, they turned out to be worthless. The complex financial products that were supposed to spread risk had actually just hidden it, creating a web of toxic assets spread throughout the global financial system. This is where the panic really set in. Banks and financial institutions all over the world realized they were holding trillions of dollars worth of these toxic assets, but no one knew exactly how much or how bad the damage was. The trust that underpins the entire financial system evaporated overnight. Banks stopped lending to each other. Credit markets froze. It was like the financial world's circulatory system had a heart attack. The dominoes began to fall, fast and hard. In March 2008, the investment bank Bear Stearns, a Wall Street giant, collapsed and was bought out for pennies on the dollar. But the real earthquake hit on September 15th, 2008. Lehman Brothers, a 158-year-old institution, declared bankruptcy. It was the largest bankruptcy in U.S. history, and it sent shockwaves across the globe. The message was clear. No one was too big to fail. Or were they? The very next day, the government stepped in to bail out the world's largest insurance company, to the tune of $85 billion. Why AIG? Because they had insured trillions of dollars worth of these toxic assets through something called credit default swaps. If AIG went down, it would have triggered a chain reaction that could have brought down the entire global economy. The crisis wasn't just a Wall Street problem anymore. It hit Main Street hard. The stock market crashed, wiping out the retirement savings of millions of ordinary people. Businesses couldn't get loans to operate, leading to massive layoffs. The unemployment rate soared. The Great Recession had begun. The American dream of homeownership had turned into a nightmare of foreclosure signs and abandoned neighborhoods for countless families. In response, the U.S. government launched the Troubled Asset Relief Program, or TARP, a $700 billion bailout for the banks. The idea was to inject cash into the system to prevent a total collapse. It was a hugely controversial move. Many people were furious that the very banks whose reckless behavior caused the crisis were being saved by taxpayer money, while ordinary citizens lost their homes and jobs. Looking back, the 2008 financial crisis was a perfect storm of factors. It was a story of deregulation that allowed banks to take on massive risks. It was about complex financial instruments that no one truly understood. It was about faulty credit ratings that gave a false sense of security. And yes, it was about human greed, a relentless chase for profits that ignored the devastating consequences. The aftermath led to new regulations like the Dodd-Frank Act, designed to increase transparency and prevent a repeat of the crisis. But the debate continues. Have we done enough to fix the system? Could it happen again? The crisis left deep scars. It eroded public trust in financial institutions and the government. It widened the gap between the rich and the poor and showed just how fragile our interconnected global economy really is. The story of 2008 is a powerful lesson. It teaches us that when financial innovation outpaces regulation and when short-term profits are prioritized over long-term stability, the consequences can be catastrophic for everyone. It is a reminder that the decisions made in the towering skyscrapers of Wall Street have a profound impact on the lives of people everywhere. Thanks for watching this deep dive into one of the most significant economic events of our lifetime. If you found this explanation helpful, please hit that like button and subscribe for more content that breaks down the complex world around us. Let us know in the comments what you remember from that time. See you in the next video.